Something happened last weekend that should make every gold and silver investor stop and pay attention. On Saturday, February 7th, 2026, the People's Bank of China released its monthly reserve data. And buried in those numbers is a signal so powerful, so defiant, so strategic, that it changes everything we thought we knew about the current market. China bought gold again for the 15th consecutive month. But here is what makes this different. Here's what makes this the most important data point of the entire year. They bought gold in January. Think about what happened in January. January was the month of the crash. January was the month when gold went from $5,600 to $4,400 in 48 hours. January was the month when silver collapsed 40%. January was the month when Kevin Warsh was nominated as Fed chairman, and the entire precious metals complex imploded. Margin calls went out. Speculators were liquidated. Hedge funds blew up. The mainstream media declared the bull market dead. And in the middle of that carnage, in the middle of that panic, in the middle of that blood in the streets moment, China was buying. China's official gold reserves increased to 74.19 million fine troy ounces by the end of January. That is up from 74.15 million ounces in December, an increase of 40,000 ounces. Now, 40,000 ounces might not sound like a lot, but when you do the math at current prices, that is roughly $200 million worth of gold added in a single month during the worst crash in decades. Let me put this in perspective. When gold was hitting all-time highs at $5,600, everyone was buying. The speculators were piling in. The retail investors were chasing the price. The momentum traders were leveraged to the hilt. That is easy. That is greed. But when gold crashed to $4,400, everyone was selling. The speculators were puking their positions. The retail investors were panicking. The momentum traders were getting margin called. That is fear. That is capitulation. And what was China doing during the fear? China was accumulating. This is not speculation. This is not a trade. This is a strategic accumulation by the second largest economy in the world. And they are not stopping. 15 consecutive months. That is over a year of uninterrupted buying. They started this current streak in November 2024, and they have added gold every single month since, through the rally, through the crash, through the volatility, through the uncertainty, month after month after month. The value of China's gold reserves now stands at $369.58 billion. Let me say that number again because it needs to sink in. $369 billion. That is up from $319.45 billion just 1 month earlier. A $50 billion increase in value. Now, some of that increase is due to the price of gold going up, but the key point is this. China is not selling. They are not taking profits. They are not rebalancing. They are holding and adding. This is a one-way street. Buy and hold. Accumulate and never sell. This is the behavior of an entity that views gold not as a trade, but as a foundational strategic asset. So why is China doing this? Why are they so relentlessly accumulating gold, regardless of price, regardless of volatility, regardless of what the market is doing? There are 3 reasons, and all 3 of them are bullish for gold and silver. Reason number 1, diversification away from the US dollar. China holds over $1 trillion in U.S. Treasury bonds. That makes them one of the largest foreign creditors to the United States government. But here's the problem. The dollar is a weapon. The United States has repeatedly used the dollar as a tool of geopolitical leverage. Sanctions, freezes, confiscations. If you hold dollars, you are exposed to the whims of U.S. foreign policy. China learned this lesson watching what happened to Russia. When Russia invaded Ukraine, the West froze Russian dollar reserves overnight. Billions of dollars became inaccessible. That was a wake-up call for every country that holds large dollar reserves. If it can happen to Russia, it can happen to anyone, so China is diversifying. They are reducing their exposure to the dollar system. And the only asset that is truly outside the dollar system, the only asset that has no counterparty risk, the only asset that cannot be frozen or sanctioned, is gold. Gold is the ultimate reserve asset. It is no one's liability. It requires no trust. It just is. Reason number 2. Preparation for a multipolar reserve currency system. For the last 80 years, the US dollar has been the world's reserve currency. But that monopoly is ending. The BRICS nations, Brazil, Russia, India, China, South Africa, are working on alternatives. They are building payment systems that bypass the dollar. They are settling trade in local currencies. And they are discussing a BRICS currency backed by commodities. What commodity? Gold. If a new reserve currency is going to compete with the dollar, it needs credibility, it needs backing, it needs something real. And gold is real. By accumulating gold now, China is positioning itself to be a leader in the post-dollar world. They are building the balance sheet that will give them leverage in the negotiations that are coming. Reason number 3, Hedge against domestic instability. China's economy is struggling. The real estate sector has collapsed. Developers are defaulting. Property values have crashed. Household wealth tied up in real estate has evaporated. The stock market is volatile. The yuan is under pressure. Capital is trying to flee the country. In this environment, the Chinese government needs a stable store of value. They need an asset that holds its purchasing power. They need gold. And it is not just the government. Chinese citizens are also buying gold. According to the China Gold Association, purchases of gold bars and coins jumped 35% in 2025. That is a 35% increase during a year when overall gold consumption in China actually declined. This tells you that Chinese households are shifting from jewelry to investment. They are shifting from consumption to wealth preservation. They are losing faith in paper assets and moving into hard assets. The government sees this, and the government is doing the same thing, buying gold, protecting the national balance sheet. Now, let me show you why this matters for the global gold market. China is not a small player. China is not a hedge fund that can be squeezed out. China is the second largest economy in the world. They have $3.2 trillion in foreign exchange reserves. If they decide to allocate even 5% of those reserves to gold, that is $160 billion of buying pressure. At current prices, $160 billion would buy roughly 1,000 metric tons of gold. To put that in perspective, global annual gold mine production is about 3,500 tons. So if China decided to go all in, they could absorb nearly 1/3 of global annual production. And they would not be alone. Other central banks are also buying. According to the World Gold Council, central banks purchased over 850 tons of gold in 2025. That is one of the highest annual totals on record. And the forecast for 2026 is similar, 850 tons again. This is structural demand. This is not hot money that flows in and out. This is patient capital that accumulates and holds. This is the kind of demand that puts a floor under the price. And here's the key insight. Central banks do not care about short-term price movements. They do not care about technical analysis. They do not care about resistance levels or support levels or moving averages. They care about one thing, accumulating a strategic asset at any reasonable price. This is why China bought in January. The price crashed from 5,600 to 4,400. A retail investor sees that and panics. A central bank sees that and thinks, great, discount. This is why trying to time the gold market is so difficult. Because while you are waiting for a better entry point, while you're waiting for the price to pull back another $100, the central banks are buying. And once the central banks accumulate enough, once the physical market tightens enough, the price does not pull back. It just gaps higher. Look at what happened in early February. Gold crashed to 4,400 on Monday, February 2nd. Everyone thought it was going lower. The technical analysts were calling for 4,000. The bears were celebrating. And then, within a week, gold was back above 5,000. A $600 move in 5 days. Why? Because the physical buyers stepped in. Because the central banks stepped in. Because China stepped in. And now, as of February 10th, gold is trading at $5,054. It has recovered almost all of the crash losses. Silver is at $82, up 15% from the $71 low. The recovery is real. And it is being driven by the same force that drove the rally in the first place, structural demand. But let me address the skeptics. Let me address the people who say, okay, China is buying gold, so what? Why does that matter for me? Why should I care what a foreign central bank is doing? Because China is the smart money. China has access to information and analysis that retail investors do not. China has economists, strategists, geopolitical analysts, all working to optimize the national balance sheet. If China is aggressively buying gold, it means they see something. They see a risk. They see a crisis. They see a breakdown coming. And they are positioning for it. Think about it. China does not need to buy gold. They could sit on their $1 trillion of U.S. Treasury bonds and collect interest. They could hold cash. They could hold euros. They could hold yen. But they are not. They are choosing gold. They are actively converting paper claims into physical metal. And they are doing it month after month after month, regardless of price. That is a signal. That is a message. That is a warning. Now let me connect this to silver, because while China is buying gold, the rest of the world is consuming silver. And silver is running out. Silver is different from gold. Gold is primarily a monetary asset. About 50% of gold demand is investment. About 40% is jewelry. About 10% is industrial. But silver is the opposite. 56% of silver demand is industrial. 25% is jewelry. Only 19% is investment. Silver is consumed. It goes into solar panels, electronics, electric vehicles, medical devices. And it does not come back. Once silver is turned into a solar panel and installed on a roof, it is gone for 30 years. This creates a structural deficit. The world mines about 850 million ounces of silver per year, but the world consumes over 1 billion ounces per year. That is a deficit of 150 million ounces per year, every year. Where does the deficit come from? Above ground stockpiles, silver that was mined years ago and held in vaults. But those stockpiles are shrinking. The registered silver in the COMEX vaults is at multi-year lows. The Shanghai Futures Exchange is nearly empty. The physical market is tight. And here's where the China story connects to silver. China is the largest manufacturer of solar panels in the world. Solar panels require silver. As China ramps up solar production, as the world transitions to renewable energy, the demand for silver is going to explode. Some analysts estimate that solar demand alone could consume 40% of global silver production by 2030. That is just 4 years away. So while China is buying gold for monetary reasons, the world is buying silver for industrial reasons. Both trends are bullish. Both trends are structural. Both trends are unstoppable. And both trends are accelerating. Now let me talk about what this means for your portfolio. If you are sitting in cash, waiting for a better entry point, you're making a mistake. You're trying to outsmart the central banks. You're trying to time a market that is being driven by forces that do not care about charts or technicals. The central banks are buying at 5,000. They were buying at 4,000. They will be buying at 6,000. Because for them, this is not a trade. It is a strategic imperative. If you are waiting for gold to drop back to 4,000 before you buy, you might be waiting forever. Because the next time we see 4,000, it might be in the rearview mirror on the way to 7,000. The same logic applies to silver. Silver crashed from $121 to $71, a 40% drop, and now it is back at 82. If you did not buy at 71, are you going to buy at 82? Or are you going to wait for another crash? And what if the next crash only takes it to 90? What if the floor is rising? The central banks understand something that retail investors often miss. The best time to buy an asset is when it is hated, when it is being sold, when everyone else is panicking. That is, when the price is disconnected from the fundamentals. That is when value is created. China bought gold in January, in the middle of the crash, while everyone else was selling. And now, 6 weeks later, they are sitting on unrealized gains, because they bought fear. So here is the lesson. Stop trying to time the bottom. Stop waiting for the perfect entry. Start thinking like a central bank. Accumulate. Hold. Ignore the noise. Focus on the trend. The trend is clear. The dollar is losing its monopoly. The fiat system is breaking down. The central banks are accumulating gold. The world is consuming silver. And the gap between paper price and physical reality is widening. 15 consecutive months. $369 billion in reserves, buying through the crash. This is not a coincidence. This is not a fluke. This is a plan. You can either follow the plan or fight it. Betting against China, betting against the central banks, betting against structural demand for precious metals, that is a losing trade. The smart money is buying. The question is, are you? Let me leave you with one final thought. Last week, while we were focused on the crash, something else happened. Multiple central banks reported their January reserves. Turkey bought gold, Poland bought gold, India bought gold. This is a global movement. This is a coordinated shift away from paper and into metal. The central banks see what is coming. They see the debt spiral, they see currency debasement, they see geopolitical fractures, and they are preparing. The only question is whether you're doing the same.